Well, if you're into real estate in any capacity, you are curious as to what's happening in the mortgage space. What is the future of interest rates? How is that going to impact homeowners and investors? Today, we're going to be breaking down some mortgage strategies for investors, the importance of working with an investor-focused mortgage broker, and busting all the myths and the rumors that are out there. If you're first time to this channel, my name is Justin Konikow. I own Prime Real Estate and the Prime Media Group, which does production and agency work, but we do a ton of work in the investment space. I've been working with guys like Scott McGillivray for years, helping them get an idea about the landscape in Southwestern Ontario. We have an amazing co-host, Lindsay Gowan, who is actually an investor herself first. I told her to go get a real estate license. Then I found out she had a background in design. So she does some really cool design work and investor-focused design work if you have questions in that space. And we are bringing on Matt Kelly. If it's your first time to this channel, again, smash that subscription button, that notification button, so you do not miss any future episodes. And you can also join the Prime Mastermind group. It is a closed group on Facebook where we post these types of events. You can meet other like-minded investors and you can network, which is so powerful in this space. On this show, we've had people like Scott McGillivray, Anna and Doug Scott, Jamie Lee Lousy Collard, Darren Voros, and so many other insightful people. And there will be many, many more to come. But let's get right into it. In this episode, we're going to do a high-level market update first. Just give you an idea of what we're seeing boots on the ground. We're not selling you anything. Yes, I own a real estate brokerage, but that's not what this space is. No pitch, no sell zone, just giving you the data so you can make good decisions. And then Lindsay and Matt are going to get heavy into the mortgage space. So let me bring them on and let's get right into it. Good morning, Lindsay and Matt. How are you guys doing today?
Morning. Doing well. Doing well.
Great. Awesome. I like the backdrop, Matt. And I see Mike Pastorius in the chat. What's up, Mike? I know you're in Windsor. I see Jaime Resendez, one of the best YouTubers out there in the real estate space. What is up, Jaime? So what I wanted to do first is just go over some stats, super high level. So I'm going to share my screen and then I want to get your thoughts on what I'm going to share both from Matt and from Lindsay. So let me share my screen here. Technology doesn't always work, but it is working now. So if you're new to this channel, what I'm going to do is I'm going to show you Southwestern Ontario, Canada. So this is the globe. This is where we're located. Everybody knows Detroit. Everybody knows Toronto. Well, London's kind of smack dab in the middle. And we operate in the greater London area, which would be Kitchener all the way down to Sarnia, Grand Bend to Port Stanley. Yes, we are bi-coastal, in case you didn't know that. And with summer right around the season, the Prime Masterminds may be popping in live soon in one of these many locations. So in the coming months, we're going to go back to doing in-persons and then also streaming live to this studio audience. So make sure you're in the group so you get those notifications. So what I did first, because I think the two primary investment markets we're seeing a lot of activity in are London and St. Thomas, was I wanted to just do a quick Polygon search, show you the multifamily properties in London, and then I'll do St. Thomas next. And then here's the actual results. So the highest price listing is 174 at King Street at $5 million for 10 units. Lowest price is a duplex for $499. That should give you a range in seeing what duplexes, fiveplexes, so on and so forth are selling for. And even one on Brothdale, which is known as a student rental area with high cash flowing, is selling for 1.7 million for a duplex. Isn't that interesting? If I go back to the property, you can see it is that old historic charming property, and you're going to have 11 bedrooms that are licensed. So having a licensed rental in London is a big thing. You have a limit of bedrooms that you can actually have licensed to 5 per unit in London. So if they're licensed for more than that, that's worth quite a bit of money. Now let's go over to St. Thomas and we could just talk about the multifamily in St. Thomas. And then I'll make one more quick note. Let me just clear this polygon really quick. I'll delete this shape so we can focus on St. Thomas. You'll also notice limited inventory. So a fiveplex for 1.5 million, a triplex for 449, and then duplexes in like the 550 to 650 range. So if I'm talking data and I'm telling you, well, you can buy a duplex in London, you can buy a duplex in St. Thomas. If your budget is on the, say, the 500 to 600 range, you're probably going to be better set looking in St. Thomas, less licensing restrictions and rental restrictions, and a lot of upside because of where things are going. But that said, rents in London are very high. So I'm going to pull these stats off the screen for a second. Lindsay, what's your kind of pulse of the market for everybody that's on the call right now?
Yeah, I was excited when you started talking about St. Thomas. I love St. Thomas, and I know Matt also loves St. Thomas, so I'm sure we'll get into that. But out there, boots on the ground, things are starting to shift slightly. So we're seeing more buyers have success in this market, where the last couple calls that we've had this year, there hasn't been that opportunity. We've had very low inventory. We still do, but I think we're sensing a bit of that buyer fatigue. We're seeing where investors might be able to have success. And exactly what we were saying the last 2 months is there's going to be a time when this kind of lets up a bit. And I think we're there. I don't know how much time we're actually going to have in this opportunity for investors. I'm sure it will heat back up again as people kind of shift, and as we do, we kind of follow that ping pong ball back and forth. So if you can get where that's going, then that's always great. So I think that's where we're at right now.
Yeah, Matt, what's your 1-2? Like, in being in the mortgage industry, what's your pulse on the market? I know there's a lot of people that are scared about the interest rate hikes. They think the market's going to crash. What are your thoughts? And I know you don't have a crystal ball, but just being in the profession, what are the trends that you're seeing?
Yeah, so we're seeing basically in the mortgage industry, we're seeing kind of two things that are going on as it relates to interest rate hikes and kind of what Lindsay was saying. There's a real opportunity right now because the media is blasting out stuff, a lot of hit pieces around investors and interest rate hikes and kind of what that means for the market, which is scaring both residential buyers as well as investors. Boots on the ground in St. Thomas, we're actually seeing, in addition to the low inventory, we're seeing duplex sales actually skyrocket up. I mean, there's been 3 properties probably in the last 2-3 weeks that have sold, in excess of 650 grand, when a year ago, those same properties, would have been tough to hit 500. So interest rates wise, I mean, yeah, we don't know, obviously we don't know. But there is a great opportunity as people go around and the impact that kind of has on prices too. So,
yeah, I can appreciate that. Well, what are appraisers doing, right? When they're seeing these properties selling so far high over asking price, but people are going in firm, how are appraisers looking at the current situation? Because I know you're in conversations with them quite often.
Yeah, so we are seeing appraisers. I mean, in conversations with them, they are a little hesitant to go with these properties that are setting kind of record-setting prices, not just for the city, but even more micro in those specific neighborhoods. I am hearing of a lot more appraisals coming up light, which is a concern for buyers. Not just, I mean, if you have conditions, that's one thing, but if you've went in firm, you now not only need to make up the difference between what the appraisal is and what you bought it for, but you still need your down payment on top. And so having multiple options sometimes helps bridge and find solutions for that gap. But appraisers are definitely being, conservative. We have to remember they work for the lenders. They don't work, for the buying agent, the listing agent, or even the mortgage professional. So appraisers are coming in light. The one interesting thing that I, learned in talking with an appraiser recently is, I mean, in looking at appraisal reports, which is something often only mortgage professionals kind of get to do because they are the property of the lender. There's only a certain amount of adjustments that they can make before a lender is going to deem that property to not be a comparable. So, we're looking at things like, obviously quality of finishes, but this is where things like the lot size and the square footage of the property play in a huge role. In order to find a comparable that hopefully justifies the purchase price for buyers.
Yeah, I think this is going back to where you do need to have a power team, right? A lot of people like to be do-it-yourselfers in the investment space, and I'm fine with that. I don't care if you use us or not, but I can tell you that when we're working on files with our clients, we're helping set expectations because they're hiring us to be experts and have our finger on the pulse of the market, so they're making good decisions. Then when we're doing offers on properties, we're calling our lending partners, getting an idea, having them pull per view and seeing where kind of the actual price should land and give them a confidence limit of like, we don't have a crystal ball, but if you go in at this price, likely it's going to appraise here. There could be a risk of an appraisal gap in this area, but giving them the tools, right? So giving them the tools, let me just go back to another set of stats that I thought was interesting. So here are a couple different areas that I pulled. So ITSO is the entire ITSO board, which is actually many markets that are in Southwestern Ontario, not all of them, but many of them. So it gives you a really good balance of data. You have London, you have St. Thomas and Sarnia. I think those are 4 data sets that are really important. ITSO's the red line, London's gray. The St. Thomas market is the blue and Sarnia is yellow. So let's go back to January 2021. The average price was $201 in Sarnia, $625 in ITSO. London was $570 and St. Thomas was very similar. Now let's go to today. ITSO's $875. Sarnia has doubled to $486, more than doubled. London's $778 and St. Thomas is $725. So London's still kind of in that pocket where it's very close to London. I do find there's a gap when it comes to investment properties that's bigger than this data set is showing. But then if you also look at new listings in the last year, you saw a big spike in March, which we're seeing right now. And actually the exact same thing as last year is happening again, where all of a sudden we're probably going to see a similar cycle. And then hold on a second, the number of sales in March spiked because there was more homes for sale. The days on market's an interesting one because it's all over the place. And this is what people are seeing right now. Properties go to market, underpriced, don't get offers on offer day, come back on market, they increase the price, the days on market goes longer, and we are seeing spikes in April. I bet you, just like we were last year, you're going to see a drop probably in May, and then it's going to probably creep up for the summer, and then I bet you fall is going to be madness again. So if people are looking to forecast trends, just look at the data. The data is there. Months of supply is if we stop selling houses today, how many days left do we have to sell houses? Sarnia is all over the map. This is insane. 1.9 is almost 2 months of inventory, which is pretty impressive. 4 months of inventory is a balanced market, but I think it's just more of a fluctuation. You can still see the ITSO, London, St. Thomas trend lines being very, very consistent and low inventory. And then the percentage of list price is interesting because this is how much over asking price stuff's going for. So back in January 2021, right around asking price, St. Thomas was actually above London. And then today, all of it, so it's about 120% above asking price. London's 124, which is nuts. St. Thomas is 117 and Sarnia is 104. A quick note I want to give people. Today, list price isn't what you're actually paying for the property. It's a marketing tool that agents are using to draw in more buyers to ultimately yield a high price. So if you're like, oh my gosh, it sold for 200 more than asking price, that could mean that the agent did a terrible job pricing it and it actually sold 100 what it should have. Or it could mean that, they priced it at a very aggressive price to yield an above average marketing price. Understand that you're actually buying tomorrow's price at a discount today. That's kind of what the market is right now too. So what I'm going to do is I'm going to let Lindsay and Matt carry on and start getting into the questions. Are you two ready for this?
Yeah, let's go.
Yeah.
Awesome. Well, you guys are kill it, and I will see you on the next one.
Awesome.
Have a good one, Justin.
Cool. Let's kick off with a question from Olivier. With the predicted increase in rates, will that cause a cap rate compression and hence prices? I know it doesn't apply to as much for small plexes.
Yeah, that's a good question, Olivier's Montreal market. Is that his? Yeah, that's what I thought. Heard him in a few.
More commercial, but
yeah, I've heard him in a few clubhouse rooms. Does absolutely a great job giving insight into the market. So, I mean, commercial. I'll be honest. So, mortgage brokers typically go into 1 and 2 silos. One is residential, which follows in line with zoning, which is anything what Olivier is kind of calling those small plexes. And I have referrals, out for commercial. Truthfully, the best bet is to go to, start to go with a bank. And then if you can't, then, find a broker in that space. But let's just talk about interest rates and kind of the overall impact, I guess, on the market, which, as Justin said earlier, I always make the joke, unfortunately, my crystal ball is on back order. Mm-hmm. But what we're going to see, within the year, truthfully, I think we're probably going to see 1, maybe 2 rate increases throughout the year. Could see one go down. It kind of just depends on how the market reacts. But with that, some other factors to consider in regards to interest rate increases is what's going to happen in the Russia-Ukraine war. That ongoing war will absolutely have an impact on rates, and inflation, and obviously inflation, and bond yields. Actually, what we're seeing now is, despite looking back, about a month ago from when we got the prime announcement from the Bank of Canada, we've actually also seen huge increases in bond yields, which is then translated into further increases in fixed rate mortgages. So when we have investors that are really focused on cash flow, whether it's in a residential or a commercial aspect, if they're only focused on cash flow, then obviously what they're looking to pay is lower. It's than what it is today, which kind of, as I said a little bit earlier, really presents an opportunity for seasoned investors who are working with the right professionals looking to employ a certain strategy. There's real opportunities for them. I'll tell you something that I know you already know, which is, Canada really relies on a strong housing market. And at this point, that really needs also a low cost of borrowing. We're living in a time where the dollars of Canadians, whether they're investors or not, feel like they're being eroded at every moment, whether that's at the pump, whether it's in the aisles at the grocery store. And with increasing rates, it's kind of why people get a little bit scared. What I like to do is talk about kind of what those increases in the prime rate mean for, as Olivier said, it kind of those small plex investors. And what a lot of my clients find out, or a lot of people that call me, is that the impact of interest rate increases is not as significant as the media kind of sensationalizes it. Yeah. Really what we're looking at is, for every $100,000 your mortgage is, a quarter point bump translates into, a $12.51 increase in your monthly payment, right? So when you look at the multiple ways to win with real estate, the small hit in your cash flow, whether it's a property in St. Thomas or London, is still offset by all the other ways.
For sure.
Yeah.
And when you really look at the numbers, it's not as aggressive as all of the hype out in the media. Like, they want you to read their articles. So obviously they're going to make it sound like it's the end of the world. So definitely get that. And that's why it's so great to have a mortgage professional on, really breaking down a lot of the myths that are out there. So I'm excited to get into all of that. But let's go back. Let's talk about how you ended up in the mortgage world yourself. Let's give a little intro to you. Did you always want to be a mortgage broker, or what got you there?
Yeah, so no, I think when I was a child, I didn't even know a mortgage broker existed. And so it wasn't something I was telling my parents that I wanted to be at a young age. So basically, relatively quickly, my backstory is I was first interested in real estate at a really young age. I wanted to be an architect. The fact that I couldn't draw really killed that career for me, even though I wasn't thinking that it was so tech dominant at the time. So I ended up going to business school, got an accounting degree, got licensed as an accountant, and then really fell in love with real estate when I started investing. And when I kind of looked at it, I was like, okay, well, is there a way to marry together my business background as an accountant with my love of real estate? And mortgage brokering kind of just made sense, because you could leverage the same skill set, provide honest advice. And that's kind of what led me into being a mortgage agent. So
awesome. And to get there too, so were you were investing in real estate before you got your mortgage license?
Yeah, I was. I had invested for about a year, and then was trying to buy my second property, and actually connected with a mutual friend of ours, Justin, and was looking on him to kind of help me get my second property. And that's kind of what started to interest me in the space. Met up with my team lead now, Jason, and it kind of just seemed like it was a good fit, and something that I wanted to, make up for the gaps that when I went through previous mortgage processes, either to buy a house or to buy a duplex, things that I wish I had known throughout there. So.
Awesome. And I think that's why we get along so well too, is I have a very similar story. I actually wanted to be an architect myself too, but then went to interior design school. It seemed a little bit more up my alley. And then I didn't always want to be a realtor. As a kid, I probably didn't even know what a realtor was. But yeah, ended up here, and it's been great. But walk us through how you got started in real estate investing. Like, what interested you about real estate investing, and what got you obsessed with that?
Yeah, so it's a bit of a long story, so we can break it up. But really, I kind of got into investing partially obviously because I wanted to, but also out of necessity. I'd had a major life change, and I was looking for a way not only to build wealth, but more importantly, to keep my expenses low. And so, like I said, it was out of necessity. I kind of stumbled into house hacking, even though I didn't know that's what it was called at the time. So I bought my first property. It was a 2-story home that had been converted into a duplex in St. Thomas. Probably I would describe it as like a C area. Not ideal, but it was the price point that I could kind of work within. And the property was in a nice little pocket that made sense. I could kind of, channel my passion for, architecture and a little bit of design, and I could see if the numbers made sense, etc. So I closed on the closing got delayed because of some, strained relationships between the tenants at the time and the seller. There's a lot of damage kind of on their way out. They smashed all the windows in the home. They stole copper pipes out of the basement, left a little bit of a mess, let's say, in their upstairs shower. And so my plan, it was a treat. They also left all their clothes behind. So nevertheless, bit of a horror story, but it all, thankfully, obviously it had a happy ending. So through renovating that property, I kind of just found myself like constantly looking. Really loved it. Learned a lot through the process, both in terms of contractors, how to price things, looking at renovations, what made sense. And I was, I'm not going to say that it was, I saw the increase in the market happening, because I didn't. I don't know, maybe many people that did. But throughout that time, value skyrocketed, rent was skyrocketing in St. Thomas.
What year was this? Sorry to cut
this
you
was
off.
like, no, it's all good. Cut me off whenever. So it would have been in 2020. Yeah, because I took possession December 2019, started renovating it in 2020.
Gives everyone context so that they know it was a hot market at the time that you were investing as well.
Yeah. So, I had locked that property up in June. It wasn't as hot at the time. Managed to pick up the property with conditions, with vacant possession as well, which was huge. And we were looking at, when I picked it up, it was under 100K per unit. So when I was running, the numbers, I knew that it was going to be a cash cow. Yeah. And at the time, foolishly, that was all I was concerned with, and missed out on a lot of great properties that in hindsight, I wish I had went in that direction. But like I said at the start, I was, extremely happy with, where it ended up going. So
we renovated a lot on the way too. So
for sure. I always laugh. I remember thinking about what our original rental budget and timeline was. And then we ran into COVID. So there was a bunch of supply chain issues, through some of the damages that happened to the property. It extended things, obviously jacked up costs. But the value of having people in your network is huge, but the lessons you learn along the way is kind of, to me, was invaluable. And so, we turned it into the pre-existing setup. So in the top unit, we had a 3-bedroom, 1-bath. And then the main floor unit, which also had access to the basement, it was a 1-bedroom, 1-bath, and then laundry for them was in the basement. And so my plan was, so the upper unit, yes, it was a 3-bedroom, but it had no living room. And sometimes, this can be a dangerous mindset to have, but it's kind of the old adage of, if I was going to live here, what would I want? And so if it was me, like, I want a living room and I also want laundry in my unit.
Yeah. And I don't think it's a dangerous mindset to have at all. Like, that's my mindset too. And I think that that's how you're going to attract your ideal clients or tenants who are your clients as well. That's who you're trying to attract. So it's a good, I do the exact same. So keep going.
Yeah, no, another mutual friend of ours, Alan and I have talked that, and he's told me that story many times. And so I ended up taking it. So we added a living room, we added laundry, and then the main floor unit, I finished the basement, turned it into a 3-bedroom unit, nice. Which, opened it up. Everything got opened up, open concept, switched the plumbing out. And so, it was financed pretty scarce. Like it was pretty scary at the time. It was all on unsecured debt. And then St. Thomas has this really great program, which is actually is still in effect today, which is called the Community Improvement Program. It's changed a little bit since when I went through it in 2020. But basically what they do is they advance you, based on quotes, $10K per unit that you're intensifying, half of which is forgivable as a grant, and then they allow you to repay it over 5 years at 0% interest. So
amazing. I didn't even know that existed.
Yeah, I can send you the link and you can share it out to however you want. But it's a phenomenal program. A lot of municipalities have them, but it's not something that's really marketed, so then people don't know about it. I know you and I, we both love leverage, and who doesn't love free, relatively speaking, free money. And so it was it was a lifesaver. So yeah, we ended up taking a property that was grossing $1,400 a month inclusive. And then we lived there for, my girlfriend at the time, wife now, lived there briefly before we got into our first house. But I mean, by the time it was fully rented, it was renting for over $3,000 a month plus utilities.
Wow.
So, I mean, to speak to your point, I mean, if you finish properties a certain way, you're going to attract the clientele that you want. And so despite the fact that it maybe wasn't in the best area, it was finished like an A property.
Yeah. And that's what I love about St. Thomas too, is you can do the units up to that like A tenant and they'll come to the C areas. In London, it's not so much the same. Like I think you have to be in a B neighborhood to attract an A tenant. Like if you're C, I don't think you're ever going to get that A tenant, but that's what I love about St. Thomas. So you can go into those inexpensive neighborhoods where you're going to, if you're looking for cash flow is going to be a little bit higher because you're still going to get those premium rents. You're going to get those premium tenants, but you're paying less for the property. So that's another reason that I love St. Thomas.
Yeah, 100%. Hearing Justin go through the data points kind of at the top, you really reinforce that. I mean, I know you and I have talked a number of times about the St. Thomas market and why we love it. But yeah, it's exactly the point that you just laid out, which is you have, lower prices than London, less licensing requirements, which is also a huge plus. But the rent gap is pretty small. Between the two areas. So
exactly.
That was
awesome.
Yeah, that was kind of the first property. So
yeah. And I love that because a big one that I have on my list that we're going to chat about is house hacking, because we both love house hacking so much. I currently house hack. Well, I rented out my unit and now I'm just kind of like freeloading everywhere, but
beach life.
Yeah, exactly. I am loving the house hacking. And a lot of the reasons that I love house hacking goes back to the mortgage aspect of things. So let's start that. Let's talk about house hacking and why it's so great.
Yeah. So I'm going to give like what it meant for my girlfriend and I's finance at the time. And then I'll go into what it relates to as a mortgage aspect. So when Kaydie and I were living there, I mean, because of what the rent of the upper unit paid, and we had refinanced, had a higher mortgage. I mean, we were living there for $400 a month, which is essentially our grocery budget, which means that you can stack up cash really quickly to help you continue to grow your portfolio. But on a practical and tactical basis, what does an owner occupied, duplex, triplex, fourplex mean for somebody that's watching this and wants to house hack? What it means is that you can get into the property for as little as 5% down versus buying a traditional rental property where you're looking at, 20% down 20% down. There's a little advantage when you're house hacking on rates as well. You save about, 10 basis points, generally speaking, on the rate, which isn't huge, but every dollar kind of counts when you're house hacking, right? So the advantage of being able to get in a 5% down and just use the power of leverage to help you scale up is huge. That's one of the big things.
Exactly. There's so many reasons why I love house hacking, but if you can get into the market sooner, you're going to go in at 5% down. Yeah, you're going to pay the mortgage insurance, but there's so many reasons why you would go in sooner, as soon as you can. And the fact is you have someone else helping pay your mortgage. So if you're concerned about that extra premium that you're paying, your tenants are like, put it in your mind that your tenants are paying that, and you're getting into the market a lot sooner than you would before. So
yeah, absolutely. Couldn't have said it better myself. So, but yeah. So
you can go 5% down on a duplex up to 500,000. Triplex, what does lending look like on house hack?
There are still lenders that'll let you get a 5% down. Oh. You kind of nailed it in your first question, or the first part of that question, which was it's 5% down up to the first 500,000. Yeah. Once you get over that, then you're like the tax system, you're looking at an incremental amount down. So you're looking at 10% down up to the next, or up to $1 million. If you're trying to house hack a $1 million property or $1 million plus property, all the best to you. You're just going to need the 20% down. So
yeah. So once it gets over $1 million, it's 20%.
100%. Yeah.
Yeah. Awesome.
So,
no, that's good to know. Fourplexes.
Same thing.
I mean, 20%.
Yeah. No, like you can. No, it's 5.
Okay.
You're not. I mean, as Justin said the stats. I mean, I don't want to be too misleading. You're not going to find a fourplex for less than 500,000.
Yeah.
So
but
it's
there's
a little misleading to put that. Yeah. Exactly. So.
And it's always different for the person themselves. Like just because there's a possibility of getting 5%, it doesn't mean that that's going to apply to every single person. Correct?
100%. I mean, it's, you always see the vehicle ads where it says OAC or on approved credit. I mean, that's really what you're looking at in the mortgage process, whether it's a residential or whether it's an investment property that you're going to live in or just use as a rental. You still have to be able to service the debt. And so, you have your gross debt servicing ratio, which is essentially a housing ratio, looks at, what your household expenses are as a division of your, your gross income. And then you have, your total debt servicing ratio, which is, housing expenses plus any debt you have kind of divided by your income, which if you're house hacking and you assume the tenant, you can include that income as part of your gross income as well. So
perfect. So speaking of that, does that actually help you get qualified for more if there is rent coming in from another unit?
Yeah, it certainly helps you, anytime there's more, there's more income or more legitimate verifiable income, it's going to help you qualify for more. The interesting thing as it relates to rental income is that, even if you rent a unit, let's say for $1,000, lenders, not just because they want to be, mostly because they want to be conservative, they don't actually add that $1,000 a month or $12,000 a month gross rent to your actual mortgage application. In the A lending landscape, which, for anybody that wonders kind of what that is, those are your major banks. There's monoline lenders, which get money from those major banks, but they only service mortgages versus banks that kind of, dip their toes in different ponds. They're typically they'll take 50% of your income that you get from that unit. So if you rent it out for $1,000, they're going to add $500 a month to the income that you make. So $6,000 a year.
Yeah. Okay. Awesome. And is that just because they're conservative?
Yeah. It's mainly out of being conservative. Yeah. They just, if you miss rent or the tenant doesn't pay upstairs in one of the units, they want to make sure obviously that you can still pay the mortgage.
Awesome. And you mentioned A banks. Are there other options out there?
100%. Yeah. So just as a quick overview of the lending landscape. So you've got A lenders, and for anybody that's looking for something really practical and tactical right now as it relates to A lenders, the best A lender, if you have a large portfolio, is Scotiabank. If you have a principal residence, you're looking to get into another property, then TD is kind of comparable there, but those are the names everybody knows. What, the greatest thing about them, especially for those people chasing cash flow, is they're the ones with the lowest rates. And so then we move into kind of B and C lenders are kind of your next tier, which they basically charge, they have a little bit higher of rates. Before we popped on here, we were looking at a spread of about, 50 basis points to a full basis, to a full point higher than, an A lender. They're typically shorter terms. But the big thing, especially as it rates, could relate to rental properties, is that they charge a small fee. Generally, it's about 1% in order to help you get into it. So what you get in exchange for that is you get a little bit better flexibility on kind of what those debt servicing ratios are. And sometimes, often, they have a different way of calculating rental income. So there's some that they'll actually take 100% of that monthly rent. So in that $1,000 unit, they may take $1,000, or there's others that'll take 80%, which is much better than the A lender at 50%. or, you know, it certainly can be. The important thing, I guess, to remember when you're looking at, you know, kind of B and C lenders, aside from the fee, is really, you know, it's two things. One, does it make sense to go down that path? But two, and more importantly, was you need to have 20% down to get into to use a B and C lender. There's no insurance product available for them.
And then also on a refinance, you're probably not getting as high of loan to value.
In the B and C space, or just in the A space, you know, just so I can answer
B and C.
Yeah, so you can still get. I mean, I've still had clients that can get 80% in the B space. I mean, if you want to run your numbers based on 75% LTV, just to give yourself a little extra wiggle room, it's not the worst case. The important thing when it comes to mortgages, whether you're looking A, B, C, let alone if you're looking at private funds, is you just need to know what your strategy is and what your exit plan is.
Yep.
I don't want to take credit for it because there's a guy on our team who I first heard it from. Shout out to Cappy if you're watching this stream, which hopefully you are, because I posted in our group chat this morning. But he talks about something called like the financing ladder. So as it relates to your rental property, you may have, you know, you may start out in a B or C space because that's where you need to make it fit within the gross debt servicing. But it doesn't mean that you can't eventually walk up the ladder to find yourself in, you know, in an A lender.
Perfect.
Yeah.
Yeah. So you might pay a little premium, again, as we talked about the mortgage insurance. Same thing if you wanted to go with a B lender to get in right away, you might pay a premium to go with a B lender, but you're also getting into the market sooner and you could climb up that ladder. Is that what you mean?
Yeah, 100%. Yeah. I mean, even if you have the fee, but even if the interest rate's higher, I mean, anybody that's looking to invest or looking to buy a property, we know the appreciation that we've seen in the market, which far outweighs what you're going to pay in terms of a higher monthly payment or with the fee, right? Yeah. So it can be a tough pill to swallow, but it's certainly one, you know, it's a real arbitrage opportunity for investors.
For sure. And actually that's what I did last year, because I was only a year and a half in to my real estate license. So I didn't have all that taxable income. My T1, T4, I don't know. You would know this a lot better. Yeah. I tried to just tune that out. But last year I had the opportunity to buy a pre-construction condo, but I could only do that if I refinanced my primary residence, which made sense. I think I was paying 2.79 for my mortgage, and everyone's like, oh my gosh, like you can get them in the ones. Like, why would you do that? And you have to pay a lender's fee, but I wouldn't have been able to do that. So, it was a great option, and I think that condo that I purchased last year is already appreciated at $130,000. So that's a great mortgage arbitrage option. So we'll get into that. I do want to go back to, you talked about fees. So with the B and C's, for you, like if you're working with an A bank, I just want to get the distinction correct. So reason why you would want to work with a mortgage broker over a bank, are there extra fees that are that people have to pay you?
No. So it's one of the common misconceptions in the space that having a conversation with a mortgage broker or using a mortgage broker, mortgage agent, terms are used relatively interchangeably. But a lot of people just assume that there's a fee, and there's not for 99% of borrowers. So if you're dealing with an A lender, there is no fee. The lender pays the broker directly or the agent directly. When you get into the B and C lenders, that is where you could start to see like a small fee to kind of set up, because those lenders typically don't pay, the mortgage professional to set it up.
And the banks don't have those options, correct?
No.
Yeah. So you're already presented with more options, all of that. So that's why it's always great to use a mortgage broker versus going to the bank, because they only have one option, right? So if they can't help you with that one option, then what's the next step? Not getting a mortgage?
Yeah. I mean, I'm not going to bash on banks because, I mean, truthfully, banks have some really good products. And as a mortgage broker myself, I mean, I have access to banks. right? And so I don't want to go too deep down the rabbit hole of, banks versus brokers. They both have really great products, but you nailed the advantage of a broker is that when they pull your credit or when you do a mortgage application with them, you just have more options, right? And so some borrowers are really concerned about, well, if you're going to pull my credit at the bank and then I have to go to a broker, like it's two separate hard checks, and the checks don't have a huge impact on, on your credit score. It's typically about a 10-point hit. But one of the huge advantages of brokers is that you have the flexibility to send it to multiple lenders should that be required. So when I look at, mortgage architects, or I look at our team, like we actually have access to over 53 lenders. Should we need that? And that doesn't include private lenders either, right? Which is definitely not something that a bank can set up for you. So
for sure. And yeah, that's what's great is that you have all of those options that you even said sometimes it might be better for you to go to the bank. And I love that. Like when someone can put their own wants aside and do what's best for the client, I think that that's why anyone is really successful. And I think that that's why you are as well. But you talk about the gaps in the mortgage industry that you kind of went through. Why do you think it's important for clients to work with why do you think it's important for investors to work with an investor-focused mortgage agent?
Okay, so that transitions well to the story of my second property, I guess. So I mentioned in the first property, it was really stressful. The renovation actually ended up costing about 110 grand, which, as I said, was all on unsecured line of credits, credit cards a little bit. And yeah, I didn't save money for a year because every paycheck I got, just slam it on the line of credit to open up more room and keep my contractors going. So I ended up actually selling that property because I realized I wanted to get into something purpose built. At this point, it was 2021. I was in the mortgage space and kind of learned about this product that I didn't know about and wished I knew about when I bought the first property, which is a purchase plus improvements mortgage. And so sold the property on Beverly, ended up buying a purpose-built triplex, also in St. Thomas. Super excited about it. I often can't talk about it without smiling. So that's why the smile is in place. And so what a purchase plus mortgage allows you to do is you get approved up front, not just for your purchase price, but a certain amount of renovations as well. And so there's lenders that have varying amounts. If it's an owner occupied property, there are some lenders that will allow you to do up to $100,000 in renovations. If it's a rental property, there's only one lender that allows you to do a purchase plus on a rental property, and their program kind of changes. At the time that I did, Kaydie and I's on the triplex, it was actually 100,000. They've since scaled it back down to 60. I hope I wasn't the cause, but anyways. So the advantage of a program like that is you basically have a guaranteed reimbursement of your funds. You still have to front them, but as long as the work is done, then you're going to get the money back, and they approve you for that higher loan up front. Some brokers and some banks are maybe a little hesitant to do it because there's a couple of maybe downsides from our standpoint if we're only looking out for ourselves, which we shouldn't be. But what some investors will do is so when you look at the BRRRR process, right, there's the buy, which is where your original mortgage is set up. And then there's the refinance later on, for the third R, I guess.
Yes.
And so as a mortgage professional, that could be 2 transactions for me, which is how some people look at it. Mm-hmm. So whereas a purchase plus bridges the gap, there's probably not a need to refinance because you're getting most of your money kind of pulled back out of the deal, if that's possible.
Yeah,
so
for sure.
Yeah, it was a program I wish, I wish I knew about. And so that was one of the gaps that I kind of looked to fill. And it worked out really great on that property. I still ended up actually refinancing it and was able to like completely BRRRR it out, down payment and reno funds.
Yeah. And that's what I love about working with a mortgage broker too, is you can see the big picture. Like you're curious about the whole story. It's the same thing with an investor focused realtor. Like when we look at things like, yes, I want to be a part of this transaction, but I want to be a part of all the other transactions that you're going to create from this property because it was a solid buy, because we put you up for success. So we're thinking about where you're going, but we're thinking about the steps to get you there too. I think it's the exact same thing with a mortgage broker. So you're able to pivot strategies if things change. I love the 5% down purchase plus improvements. Like that's one of my favorite strategies. I think that you're probably leaving less money in the deal sometimes than if you are to fully BRRRR something. When you're BRRRRing, if you have to go 20% down, it might make more sense for a refinance, but with the 5% down, it seems like a win every single time, because my first property, I did the exact same thing. And I think it was someone that just mentioned in passing, they're like, hey, did you know that you can get your mortgage or your renovations built into your mortgage? And I'm like, I had $8,000 to my name at this time. Like, this is when I'm buying a $104,000 condo. I'm like, yeah, like I want to do that. So I just asked the bank, like, and it's me asking the questions as well, because someone had said to me, and I was like, this was before my real estate investing days. So I didn't even realize I was a real estate investor. So I did 5% down, purchase plus improvements. I think my whole mortgage was $114,000 because I did $10,000 in renovations or whatever. What a win that was. And then I did the exact same thing with my duplex when I bought that. I think I had $38,000 in the whole deal of buying a duplex, and I lived in it, and it brought me in rent. So it's a great strategy with house hacking. I think that you can like pair all of these great strategies together. But do you want to talk to us about the BRRRR strategy just from a lending perspective? So if you hear someone that's wanting to do a BRRRR, buy, renovate, rent, refinance, repeat, for anyone that doesn't know what a BRRRR is, what does that look like from a lender's perspective? What would you talk someone through when they're wanting to do that?
Yeah. So the first question, I mean, it's how I start pretty much every conversation, whether somebody's looking to BRRRR or not, but it's like, what are your goals and what are your plans for this property? Right. And that comes in both on the buy, but also on the refinance, because depending on what the answer to that question is, depends on like, are we going for the max amortization at 30, which is really important, 30 in the A space. Because that's really important, because we need to keep your debt servicing low as you look if you want to grow your portfolio. So from a lending standpoint, walking through the buy, we're obviously getting you ready for the application up front. If you tell me you want to BRRRR it, then what I'm going to ask you is, what is the after repair value or ARV? Because what I want to be able to do is set you up for the refinance if that's the path that we're going to go. Or, whether it's a purchase plus or whether it isn't. So then, I'm kind of checking in throughout your renovations, because some lenders do put a time restriction if you're going a purchase plus on how long you can take to do the work. So we're starting to get things as you're going through, you're rehabbing the property, you're renting it out. If I know that we're setting up a refi, it's like, okay, well, once you get those rent agreements in hand, fire them over to me. We can start to set up the refinance. We'll go through it. And just make sure that you're in the best position to have the exit strategy you want. So that's kind of that's what the BRRRR process looks like from a lending standpoint. It's talking with the client, it's talking with their professional that they're working with. Hopefully it's an investor focused realtor, about what the ARV is, what's the plan look like, how feasible is it? Because as somebody that's been caught up in renovations myself, sometimes even myself as a client, you get some unrealistic views as to maybe what you think the property is worth, or what you're going to be able to rent it out for. So it's important to have that conversation up front, but also throughout the process to see if we need to adjust the plan that we're working towards.
Exactly. And I think it's so important to have that active communication between everyone. Like your power team needs to be communicating. It's not just you and whoever else you're talking to, everyone needs to be on the same page so that you can achieve this BRRRR. Because yes, again, you could get really high ARVs in your mind, but if it's not there on paper, then it's not going to translate, and you're not going to be happy when you refinance. I rather set expectations low, and then you're really happy with me when it comes in much higher. But
for sure. And I mean, if we're looking for a property that you're looking to refinance, I mean, I keep in communication with appraisers, but I'm also, especially as it relates to the St. Thomas market, always looking for comps. And so it's one of the things where it's like, okay, I'm also kind of stress testing your ARV as we go through the process with changes in the market.
Nice.
Because I know that's going to be important when we go and we submit your refi. So
awesome. Okay, so if you're flipping a house, so we're just doing the buy, renovate, and then sell. No refinance, nothing. Is there certain products that are better? And how do you work with clients on flipping properties?
Yeah, so flipping, first question is, what do you think you're going to sell it? Like, it's what do you think you're going to sell it for? What's the timeline? What's your budget look like? Et cetera, et cetera, et cetera. What are you doing? Because I just want to understand the scope myself, not just because I love investing, but we just need to understand where we're going. And then we kind of just analyze, like I analyze the strategy and we decide, okay, are you going to a bank, or are we maybe open to considering private lending? Because for as much knocks as private lending gets, one of the things it really saves you on is fees. And the downside of somebody that is, let's say, a serial flipper and you're always going to the bank is that yes, you're paying the setup fees, but there's a risk that you could damage that relationship. Banks don't necessarily want to set up a mortgage only to discharge it 3 months later. And so while they're probably cool if you do it, once, twice, maybe even 3-4 times to help build up some capital, eventually there's a risk that they could cut you off. It's not definitive by any means, but the flexibility is something where like private lending may come in huge. So there's not private lending. I mean, I wouldn't necessarily define it as a product, but it's something worthy of consideration, especially because every private deal is different.
For sure.
So some private lenders will advance you, some rental funds, or can structure it like a bit of a construction mortgage, which is not something that, a bank is going to do.
Definitely. I think my light went out here. Exactly. So I think a lot of people get caught up in what they're paying lenders for the money, but they're not looking at long-term, like what am I making from this? Like there's so many benefits to that private lending, and to like, maybe you're not making as much money, but if the deal doesn't work with like an extra $10,000 or however much you're paying in lending fees, like maybe it's not the greatest deal, and maybe that is a telltale sign that you should probably just move on to a better deal. But for short-term rentals, is there different mortgage types that work better for that?
Really, it comes down to like lenders. So when Airbnb first came into the scene, or STRs in general, a lot of lenders were really hesitant to touch it. It depends on how your short-term rental business is structured in terms of where in the lending landscape we're going. From my conversations and my limited experience with, admittedly with short-term rentals at scale, they tend to be sliding into a bit more of the B space. From what I've seen, there's just more flexibility they're willing to offer there. As you build it out and it becomes like a sustainable business, then you could look at some programs, again, jump up the financing ladder and maybe get into the A space. But similar to privates, it's all about understanding what your strategy is, what the goal is long-term, and finding a solution that helps you hit your goal, if that makes sense. So
yeah, definitely makes sense. That's awesome. Let's bust a couple myths, because that's what this whole thing is all about. So we've heard a couple times that investors might have to increase their down payment. Is that happening? Do we have to pay 35%?
So the interesting thing about that, so I first started hearing about it in January, put a little post out about it. It went nowhere, which is fine. So the root of the idea is that there's this think tank group out of UBC. And the whole reason why this is being tabled is because there's a lot of investors get right, wrong, or indifferent. A lot of kind of slack in the market because, or a lot of slack in the media because they're being portrayed as people that are, you know, snatching up all the housing supply, and are buying, you know, buying speculatively, both foreign and kind of domestic investors. And so this think tank group had the idea, okay, well, what if we increase the down payment? What impact will that have on, you know, on the housing market? Will it increase housing supply essentially? And so they talked about increasing it to as little as 25% down, which is only a 5% increase, and kind of deemed that there wasn't going to be probably much of an impact, which is where this sliding scale of 25 to 35 came in. It's not in action by any step. It's certainly being talked about, but it's nothing hard and defined as to 100% this is happening. So should it come into action, I guess my opinion is there's two kind of questions to kind of ask or to think about if you're an investor. So the one thing to look at will be, is this applicable to just purchases? Because if it's applicable to just purchases, I think there's going to be some savvy investors who are going to maybe go in unconventional ways of financing it, i.e. maybe going private, and then will they just refi traditionally? I know that's what I would do. Yeah. If, you know, certainly if the right property came along and it made sense, etc. So if it's applicable to purchases and refinances, that's a different story. But if it's just applicable to purchases, I think it's going to have no impact, or very little impact. But the other thing is, when you think about it, like I think about, okay, well, who's this going to impact the most? And the reality is it's going to impact small multifamily investors, you know, somebody that has under 5 properties, let's say, because they're not deemed, you know, they're not deemed commercial, or they're not cut off with some lenders from being deemed residential investors. And I also think renters are going to be drastically impacted by this as well, which is unfortunate for a variety of reasons. But I mean, as you and I probably both know, I mean, rent is insane right now. There's not housing supply, but there's also not a lot of rental supply, to the point where we're actually seeing bidding wars on rental properties for renters. It's wild. But there's something that is terribly ironic should this ever come into effect, which is that for investors that are looking, you know, kind of as Olivier talked about earlier, you know, your large investors, 10 plus units, 50 units, apartment building style investors, they have access to a CMHC program that allows them to buy large buildings at 5% down with a 50-year amortization, which is something hilarious that they have such a great program, and yet we're looking to, you know, do the proverbial slap on the wrist of people that want to buy like a 2 to 4 unit property. So yeah,
and it's always the way too. Like it's the media. They're doing something to help, something that doesn't actually help, and then it actually creates that media attention towards investors being these evil landlords and like just in it for the money, all of that. When in reality, there's a lot of governmental aspects that they're doing that create all of the higher rents, the there's just the negative media that's out there towards that. So no, that's great to touch upon. You did mention about the residential versus commercial mortgages. So something that I hear quite a bit is, I can't qualify for a residential mortgage, I'll just have to go commercial 5+. What's your perspective on that?
So, okay. So just to make sure I understand your question. So we have somebody that it sounds like they can't qualify. Like they're buying a triplex, or they're buying like a 6 or a mixed use.
So they're typically buying duplexes or triplexes. And then the banks has told them, no, sorry, we can't give you any more mortgages. Or from another perspective, maybe I'm just starting and I can't get qualified for an A lender bank. Should I just go and do commercial lending, like 5+ units?
Okay, interesting. So yeah, I mean, commercial lending is defined as anything that's five plus, or if you're maybe you're buying a triplex, but the main floor unit is like it's a storefront, so it's a mixed use property with heavy commercial zoning. That's kind of what gets slid into commercial.
Yeah. And I think the perspective is that it's the building that they look at when it's commercial. So if I can't qualify residentially, then I should be able to qualify commercially if the building makes sense.
Yeah, so it's an interesting viewpoint. It's admittedly not one I've run into, but my quick thoughts would be typically commercial mortgages are actually a lot more difficult to have come together. It's a lot longer of a process. Because when it comes to commercial mortgages, it's really it's risk based, and so often what we see is a lot lower LTVs in the people that I've chatted to about this, like somewhere maybe in the neighborhood of like a 60, 65, maybe 70%, and you're going to see a lot higher interest rates, especially to your point if it's somebody that's just getting started out, and so. On the residential side, yeah, I haven't, like I said, I haven't heard that. The question becomes, are you open to other options, whether it's private, whether it's a mortgage investment corp or like a MIC, which is slightly above private lending, to help you get into the property. But typically it's the zoning that dictates where you're going. And so, like I said, if 4 units and below, some lenders allow 5, but mostly speaking, it's 4 and below. You're going residential.
Awesome.
Yeah.
Perfect. No, that's great. We're getting over time here. Let's just do a couple quick questions. I'm going to ask you first. What are you up to now? What are you working on investing wise? And where are you seeing opportunity in investing?
Yeah, so much to the chagrin of my lovely wife, I am always looking for properties. I actually offered on one last week in St. Thomas. Didn't come together. So I'm kind of just, my whole thing is I don't need to be somebody with 50 doors. I just want a handful of properties that perform well. Yeah. And so that's kind of what I'm looking for. I'm looking for one more property probably one more property that allows me to set up and just have kind of that passive cash flow. So that way maybe I can be, like you were a couple of weeks ago, traveling in Costa Rica and collecting rent. Thanks, Eddie, for popping into the stream.
Hey, Eddie.
So in terms of opportunities, I mean, I hate to keep beating this point home. I think in the 2 weeks leading up to a mortgage rate announcement, and then if there's an increase, probably the 45 days after are a great opportunity for anybody to pick up a property and to just build off the negative hype.
Such a great tip.
That's where I think the greatest opportunity really lies.
No, that's an amazing tip. I think that if anything else, we've gone through so many things, but that is such a golden nugget that everyone's looking for that perfect time to buy. We are thinking it's all such a hot market, right? But there's micro things happening there. So if you can hear tips from people in the industry, hear that. So that's a great one. Let's just do a quick round, a little quick questions.
Yeah, rapid fire round.
Yeah, that's what it is. I forgot the term. Rapid fire questions, and then I will let you get on with your lovely Saturday.
Okay,
so
sounds good.
What is something that people have a misunderstanding of or misconception of with mortgages?
With mortgages or the industry in itself?
Yes, or the industry.
Yeah.
Yep.
Okay, got you. So the reality is this: there's about 14,000 mortgage professionals or mortgage agents in the industry, not including the ones in banks. The reality is, and something that's misunderstood, is that we all more or less do the exact same thing and can offer you the exact same thing. For all the mortgage brokerages that are out there that everybody's kind of familiar with, your DLCs, your mortgage architects, your RMAs, et cetera, they all roll up into roughly 3 parent companies. So we all have access to the same lenders. We have access to the same rates. And so find somebody that works well with you, understands where you're trying to go. Obviously, they need to be knowledgeable, but everybody thinks that they should always go to the bank because it's their best interest. And that, the bank only has stuff that only the bank has. Apologies if you can hear my dog. Probably somebody's walking past the house and she doesn't feel they have a right to do that.
No, rude.
But we all more or less have access to the same products. So that's something that not a lot of people understand.
Awesome. Okay, cool. If you could turn back the time and talk to your 18-year-old self, what would you tell him?
That's a good question. I would probably tell him to focus on 2 things in his life. I mean, you need to understand the value of relationships, but you need to also understand the importance of learning, whether that's from books, whether that's from failure. If you understand those things, and I guess also if you focusing on those 2 things will allow you to basically make a life and not just be so focused on making a living.
Love it. Yeah, that's awesome. If in 150 years science fails to save us and all that is left is a book about your life, what would the title of that book be?
That's a great question. So it would be Life's About Lessons, how to buy 4 properties, renovate 3 of them, all without having a vehicle license.
Love it. That's awesome. Awesome. Well, thank you so much for your time, Matt. Always a pleasure chatting with you. I know that we will definitely chat more offline daily. It's always great to keep up on whatever's happening in the mortgage industry, especially how it relates to you as an investor. So I would highly recommend having an investor-focused mortgage agent on your team. Matt, where can people find you?
Yeah, so on Instagram is probably one of the best ways where I put kind of out the most content. So Instagram, Facebook, both under the name @MK Lending Solutions. Recently started a YouTube channel. Don't judge me too much. We're trying to get it going. So it's just Matt Kelly Mortgage Agent on there. So those are probably the best spots. Thanks, Dev. And so anybody that's interested can reach out to me there, and then we can connect offline from that point. But those are probably the best starting points for sure.
Love it. And I love how you're putting yourself out there on social. I know that we always chat about that too, how uncomfortable it is, but it is such a benefit. Even just having you on the podcast this morning, I've learned so much. So it's so great to be able to put yourself out there and show everyone that you definitely are the expert in that area. So you're going to attract your ideal client so much better. But a big thank you to everyone that's listened today, everyone that's tuned in. Make sure you subscribe so you don't miss any more great episodes like this. But Matt, I'm going to leave you to your Saturday, and have a wonderful day, everyone.
Yeah, thanks a lot for having me on, Lindsay. Appreciate it.
Thanks, Matt.
Cheers.